Hello there everyone. Today's video we're going to take a look at a case study of a business looking to do some tax planning and also some restructuring to get protection of assets. So ring fencing valuable assets in the business from attack from any potential creditors or anyone who wants to sue the business. So let's just have a little look at this. Now this is a trading business. Let's assume you've got this husband and wife, shareholders. He's the director, but they both got shares, so he can pay her a dividend in addition to himself. Wife works in the business, but he's the only director, and they rent some premises, the local town. Got this consultancy business doing very well, starting to accumulate quite a bit of cash. So every year, building up profits, live a modest lifestyle. They're not rinsing the business. They're paying themselves a bit of salary, some dividend each, but there's cash accumulating. So what do we do about the cash that's building up? And what about saving a few quid on the corporation tax? So here's one thing you can do. Insert a holding company. This company here. Now, if you've got a company that's already in existence, if you're going to drop a company underneath, create a company below, that takes about 5 minutes and it's dead easy creating a subsidiary. If you're going to do it in reverse and create a company above, slightly more complicated. You have to go to HMRC and get special clearances to do this, clearances that there'll be no tax implications. Because in effect, what's happening is the shareholders here are getting rid of a valuable asset, i.e. the company, but they're getting this one in exchange. So HMRC have to give you clearance that there's no capital gains tax. So, but once you've got the clearances from HMRC that there's no tax for creating a company above an existing company, then what you do is you just hive up valuable assets that you want ring fenced. Because God forbid anyone sued this company, because it's below the top co, anything that you put in the top co is protected, it's ring fenced. So typically you'd put surplus cash. Like I said, the company's done well, been going a few years, built up the cash, move surplus cash, we're talking surplus to working capital requirements down here, move it up there. Maybe this guy has started dabbling in crypto and he's opened up a company crypto account and that's started to go through the roof, and he's like, you know what? I don't want that at risk down here. Let's also park that upstairs. You can do anything you want in terms of assets that you can hold in a limited company. There's no restrictions, unlike pensions, which we're going to come on to. But in this limited company, let's assume he's got a load of cash, he's got a crypto account, and it's parked in the top co. Him and his wife, shareholders of top co. Top co owns trade co. 100%. Great. So that's problem solved in terms of ring fencing assets. Now then, what about tax? So we've already said, well, yeah, okay, he's paying, him and his wife paying themselves minimal salary and the rest dividend, getting the credit for state pension purposes. Fine. So the tax issue isn't really an income tax one, it's more of a corporation tax one. Doing great profits year on year in their consultancy business. So, pension contributions. Now, pre-year end, put into a pension. Annual allowance, 60,000 a year. Let's assume that there isn't any capacity brought forward, 60,000 a year. So, like I said at the top of the video, both of these individuals, husband and wife, are shareholders in the structure, but only he is a director. So, what does he do? Makes the wife a director. And the reason you would do that is because they then can put in an additional big chunk of change into the pension for her from the company. So assume he wants to do 60 grand. All of a sudden, she's now a director, and HMRC say, yes, as commensurate duties for being a director, you're allowed to put in a decent whack into your pension that you couldn't if you were just a regular employee. But But as a director, you can. So all of a sudden, she's a director. He does 60 grand into pension. She does 60 grand into pension. That's 120 grand coming off the profits. Now, let's assume as well that this is a June year end. All right. So June 2026. And they say, right, let's get some pensions in right now. 2 lots of 60,000. She's a director. He's a director. That's 120,000. That limit on the 60 grand a year on the pensions is actually per fiscal year, the tax year, 5th of April, 6th of April to 5th of April, right? So, but in the company, this company's got a June year end. So what they could also do, assuming, like we said, they're pretty flush for cash, profits are good, they can do 2 lots each in the company's financial year, assuming they haven't done, they could do this next year, next financial year, the fiscal year, and both will be in the company accounts. What do I mean by that? So, timeline. 60,000, September 2025, husband and wife, 120 grand combined. But what I'm saying is they don't have to wait until the next company financial year, which is going to be after July 26, to do another round of that 2 lots of 60. All they'd have to do is wait till the next fiscal year, which is the 6th of April. So they could double up. So not only are we doubling up for the guy who was sole director to begin with, but now his wife is also a director. We're kind of quadrupling up, and we're saying, right, 4 lots of 60 grand, 2 lots now, 120,000 in the 25-26 fiscal year, and then we'll do another 120,000 just into the 26-27 year, but still in the year ended June 2026. Okay, so that's 240,000 going into this pension. And they've got this pension and they've said, right, ideally, we'd like to buy the commercial building that we're currently renting. Right, okay. So they've loaded it up with 240,000 of cash. The building that they want to buy, that they're renting already, was come on the market, then great. How much is it going to be? 350,000. Okay, so, well, do we just wait? Do we wait another year or two and do more contributions to get to that level? Well, they don't have to necessarily wait, because they can go to a bank and borrow the balance. The pension can borrow the balance to acquire the property immediately. Now, the rules say that a pension fund can borrow up to 50% of its value. So we're saying that its value is 240,000. So it's 4 lots of 60,000 pensions gone in. The building that they want is 350. So what do they need to borrow? So they need to borrow 110 grand. But that's fine. That's within the parameters of the borrowing capabilities of pensions. So 50, it's not excessive borrowing based on the value that's already in there. So then they go to a bank, they get a mortgage for 110 or maybe 120,000, some legals and stamp, what have you. And then they've got this commercial property that they were formerly renting, which they now own, but they own it in their pension fund. Well, that's terrific. So the monies that were going out before on rent, yes, they're tax deductible. They still remain tax deductible for the company. But on the flip side, as it were, they are now tax-free upon receipt in their pension fund. So the money comes in here, the rent, tax-free, as do the future contributions. And they use that rent to pay off the bank. And it'll be paid off in, not too many years, I would suggest. If, let's say, I don't know, 30, 40 grand a year rent, well, they've only got 120 grand debt on there. And of course, they could pay it off quicker because the contributions that go in as well, they've got more cash that's building up year on year. So that debt to the bank could be paid off pretty quick. The point is, you don't have to wait to accumulate enough pot to buy the building. If you're going to risk losing the building, that's another way to get it sooner than you would have thought. Load up the maximum amount of cash, pension contributions that you can, and then leverage up on the rest. So that is how you could acquire commercial premises through your pension fund, using your business to fund the majority of that, all tax deductible, with a combination of bank debt. And that is a useful planning tool. So we've got corporation tax savings going on here, big savings, and of course the insertion of a whole co for asset protection. Now, in my example, with the numbers going forward year on year, you can't double up and say, well, I'm going to do 2 lots of 60 twice. You can only do it the first time that you do that, when you say, right, we're going to do it either side of the 5th of April. Because once you've done it the next year, then you would have to wait until the following year to do it again. But if you haven't done it before, that first time that you do it gives you that one-off boost in terms of accelerating the amounts that you get into that pension. If you want to get in money quick to acquire that building, that's how you do it. So an interesting little example there of some corp tax planning, some asset protection, some pension planning. If you like this video, please do subscribe. And as always, I'll see you soon.